The United States spent decades building the most powerful economic empire in history. But today, right now, the walls aren't just cracking, they're exploding. Not because of war, not because of weapons, but because the world is quietly trading America away. While Washington clings to old assumptions, trillions are shifting hands in Beijing, Tokyo, and beyond. And by the time America notices, it might already be too late. In April 2025, senior U.S. trade officials privately floated a tariff review framework for Chinese imports, according to the Wall Street Journal. The leak timed just weeks after Chinese President Xi Jinping inked a record $180 billion commodities pact with Brazil and Saudi Arabia, which sent yuan-denominated assets surging 2.3% in a single trading day, an unmistakable sign that markets saw the move not as strength, but retreat. William Reinsch of the Center for Strategic and International Studies noted bluntly, "This is not recalibration, it's triage." Meanwhile, Beijing moved to tighten export quotas on critical minerals, amplifying the perception that Washington's leverage is eroding. If tariffs once symbolized dominance, today they resemble economic liabilities, and the consequences are stacking fast. But if you think tariffs are America's only unraveling front, brace yourself. The real trade war casualty may not be China at all, according to Bloomberg Economics, March 2025. After 6 years of tit-for-tat tariffs, U.S. consumer prices for electronics, apparel, and home goods rose an average of 11.8%, compared to 3.2% inflation in China's targeted export sectors. Today, the effective average U.S. tariff rate on strategic Chinese goods exceeds 130%. Crippling small and medium-sized American businesses that depend on affordable imports. Jim Tankersley at the New York Times reports that U.S. manufacturing output shrank 2.7% year-over-year in Q1 2025, the steepest decline since 2008's financial crisis. And as Wall Street adjusts expectations downward, Beijing quietly reroutes its goods through Vietnam, Indonesia, and Mexico, neutralizing pressure points Washington thought were fatal. But the biggest vulnerability isn't about supply chains anymore. It's about survival. Behind closed doors, few policymakers deny it. Decoupling sounds good on TV, but it's a death sentence for key U.S. industries in reality. Data from the U.S. Census Bureau, April 2025, shows that over 82% of imported lithium-ion batteries, 67% of rare earth magnets, and 35% of consumer electronics still come directly or indirectly from China. Goldman Sachs estimates that replacing Chinese imports with alternatives would spike costs by 28% on average across consumer sectors within 18 months. Real-world pain points are already visible. Ford's F-150 Lightning production paused for 2 weeks in February due to semiconductor shortages tied to Chinese subcontractors, costing an estimated $780 million in revenue. The so-called Great Uncoupling risks becoming a self-inflicted economic tourniquet, and the bleeding hasn't even peaked yet. But there's a deeper threat Washington didn't anticipate, a fiscal cliff looming just beyond the tariff walls. Let's hit pause, because while tariffs dominate headlines, the real-time bomb ticking under America's economy is debt. The Congressional Budget Office projects that U.S. federal debt will surpass $37 trillion by December 2025, reaching 126% of GDP, the highest peacetime debt load in modern history. Servicing that debt already consumes over 9% of GDP annually, according to Moody's Analytics. Meanwhile, China has quietly trimmed its U.S. Treasury holdings by another $118 billion over the past 12 months, bringing total Chinese ownership to a 20-year low. Mark Sobel, former U.S. Treasury official, warned in Financial Times this March, if Asian capital starts flowing east instead of west, America's fiscal flexibility evaporates. And here's the cold reality. If debt service costs surge just 1.5% higher, Washington may have no choice but to gut tariffs and any remaining leverage just to keep markets from spinning into crisis. But Beijing isn't sitting still. They're making sure that even if America surrenders, it won't matter. In 2025, while Washington escalated tariff threats, China locked down the most vital pressure points of all, energy and resources. On February 17th, Beijing signed a groundbreaking deal with Saudi Aramco for 25-year crude oil deliveries priced entirely in yuan, with the agreement valued at $75 billion over its term, as reported by Reuters. Days later, China secured a 30-year LNG import contract from Qatar Energy worth $45 billion, simultaneously finalizing rare earth mineral partnerships with Zimbabwe and the Democratic Republic of Congo. Helen McCroft at RBC Capital Markets summarized it bluntly. China is methodically removing any future scenario where U.S. financial pressure matters. Energy independence from Western-controlled systems means China no longer fears dollar-based sanctions, and its Belt and Road partners are following suit. The International Energy Agency reported last month that 31% of China's imported energy is now transacted outside the U.S. dollar, a doubling since 2019. If Washington thought tariffs could isolate China, Beijing just proved it could isolate Washington from the global economy itself. And what's coming next makes today's collapse look like just the opening move. Global capital doesn't wait for elections, it follows returns. In Q1 2025, Bloomberg data revealed that U.S. equities suffered $43 billion in net outflows, the largest quarterly withdrawal since 2009. Meanwhile, China's CSI 300 index climbed 18%, fueled by record foreign direct investment surges into Shanghai's free trade zone and Belt and Road infrastructure hubs. Morgan Stanley analysts noted that market behavior now reflects a structural realignment, with global investors rebalancing portfolios toward Asian economies perceived as more stable amid tariff uncertainty. Goldman Sachs warned in April that if U.S. protectionism persists, capital will seek efficiency elsewhere, permanently. Every dollar moving east signals something deeper than momentary sentiment. It hints at a tectonic recalibration few in Washington seem prepared to counter. But if the money's moving, you'll want to see where alliances are shifting too, because that's where the real story breaks open. For decades, Japan was America's economic anchor in Asia. But in March 2025, Prime Minister Shigeru Ishiba signed a bilateral framework with China covering infrastructure development, AI collaboration, and direct currency swaps bypassing the dollar, according to Nikkei Asia. This wasn't a symbolic move. It was an $80 billion annual trade pipeline realigned toward Beijing. Masayoshi Amamiya, former deputy governor of the Bank of Japan, stated bluntly, Japan's strategic priority is resilience, not allegiance. The collapse of TSMC's U.S. Arizona chip project earlier this year, facing ballooning costs and permit delays, served as a wake-up call for Tokyo America's industrial capacity could no longer be blindly trusted. With China guaranteeing semiconductor access, critical minerals, and massive capital for Japan's green transition plans, economic self-preservation, not loyalty, is now driving foreign policy. And if Tokyo is hedging its bets, how long until others start sprinting? The implications of a Tokyo-Beijing economic axis extend far beyond trade volumes. According to the Bank for International Settlements, in April 2025, Japan began settling 23% of its bilateral trade with China directly in yuan, a move that bypasses SWIFT and minimizes dollar exposure. If Japan, then ASEAN, and eventually India, normalize non-dollar trade settlements, the financial architecture underpinning U.S. global dominance could erode faster than anyone modeled. HSBC economists warned that a 15% global reduction in dollar reserves could push U.S. long-term interest rates up by 1.7 percentage points, triggering a $480 billion annual surge in debt servicing costs by 2028. This isn't theoretical, it's mechanical. But even that might underestimate the danger, because financial gravity doesn't just shift power, it accelerates the fall of those who cling too long to the old rules. Look past the press conferences and you'll find the real scoreboard. China's Belt and Road investments hit $145 billion in new contracts in 2024, according to Financial Times, a 12% jump year over year, even as Western media declared the initiative struggling. Meanwhile, IMF data from March shows a stunning 28% of global reserve managers have added yuan to their portfolios since 2022, while 18% have reduced dollar holdings, citing geopolitical risk and monetary policy volatility. Latin America, Southeast Asia, and Africa aren't debating trade loyalty. They're signing deals denominated in yuan and strengthening supply lines through Chinese-built ports, pipelines, and railways. In real terms, power is no longer moving in press releases or speeches. It's moving in shipping manifests, balance sheets, and bond issuances. And right now, it's moving away from Washington at a velocity that few there seem willing or able to stop. But if you think the tariff war was the main battlefield, what's coming next will make today's trade collapse feel like a sideshow. The trade war isn't ending. It's mutating. As China locks down commodities, rebuilds financial alliances, and carves new arteries for global trade, America faces a choice no one in Washington dares to say out loud: adapt or watch the dollar, the debt, and the dream all unravel at once. But there's one final, even bigger move happening right now, one that could permanently fracture the world's financial order. And it doesn't involve tariffs, bonds, or even trade deals. It involves something far older, far deadlier. We're glad you're enjoying this video. Please like and subscribe. Check out another video that is now on your screen.